Hey there, my name's Curtis Lucas and you're watching Empire Building. I just want to take a moment and thank anyone who turned up for my first live stream. Technically, it's my second live stream. The first one failed miserably. Some of you may have been around for that sometime last year. But I wanted to go in a little deeper into the topic that I introduced in today's live stream. Sharing some of my screen and the information that I was looking at, because I do think that this is very important to understand going forward. We need to understand and reconcile what the incentives are in this industry in terms of the investors in it and the market makers in it. As we know, there are a lot more institutions involved today, and they behave differently than retail investors. And the incentives for them are very different from ours. And of course, what I'm talking about is this theory known as the maximum pain theory. It all has to do with the options market. Now, I know some of you are familiar with options. Other people are terrified of them for good reason. And others just purely don't understand them. Now, I may do a video in the near future talking more about options, but I will cover the basics in this to give you a general idea what they are, how they're used, and how they influence the market as a whole. This doesn't just apply to mining stocks. This applies to all stocks. So there's a good chance we are going to fall down a rabbit hole, but stay with me. I promise you this will be worth it. So I want to start off with a quick recap of the Bitcoin price and that chart. As I mentioned in my live stream, we are in a definitive uptrend. We've touched this trend line 1, 2, 3, coming up probably fourth tonight, between tonight and the open of the market tomorrow. Let's hope this trend line holds true. And the next time we really have anything significant to worry about is the major trend line that we've been in ever since we touched $69,000 last October. So yeah, that the intersection of these two trend lines puts us at about $46,000 thereabouts. So what I'm thinking is probably going to happen here is we could make a quick push up for 46,000, potentially as early as tomorrow morning. Ultimately, I don't think we'll break through it, at least not on the first try. And we'll find some other further consolidation that could take us into the end of next week. And that plays into exactly what I'm going to be getting into in this video, that topic. That's why I wanted to start with the Bitcoin chart and sort of lay the groundwork. So considering the fact that we have been in this uptrend for the last few days, we've sort of been seeing, as I mentioned, a sort of lackluster performance from the majority of the mining stocks, in particular the big ones, Marathon and Riot blockchain. Now, this is what we are going to talk about. I'm going to be sharing this link down in the description. There's a great website called Swaggy Stocks. This website is going to give you a whole lot of information pertaining to many different things. But my main reason for having a look at this is their maximum pain calculator. You can see that in the menu options on the side here. There's a lot of other stuff I haven't actually had time to go through. I've actually only found this website today, but I'm familiar with this theory, and they also get into that in their description here. Basically, what they're saying is max pain theory suggests that the underlying price for the option, or the stock price in simpler terms, will be pinned to a specific price at options expiration, also known as OPEX. This would inflict the maximum amount of pain in dollar loss for all options holders, which include those that bought calls and put contracts. So for those of you that don't know, a put is a bet that the price will fall. When you purchase a put contract, you're betting the price is going to drop. And a call is where you think the price is going to go up. On a very basic level, the thing to remember about contracts is when you're purchasing a call, you have to select an expiration date and a strike price. This is what makes options contracts so much riskier, is that not only do you have to guess or predict the direction of the price movement, you also have to correctly guess the timeline. You have to pick an expiration date that you believe the price will be above in the case of a call, or below in the case of a put, a certain price. That price is known as a strike price. So whether these contracts are puts or calls, those at any given time, those contracts will either be in the money or out of the money. Again, I know there's a lot of terms here, but when a contract is in the money, and it doesn't matter if it's a put or a call, remember, calls meaning the price goes up, put means price go down. If you purchase a call contract with a strike price of $30 and the current price is less than $30, then you are out of the money. If you are above $30 and you own a call, then you are in the money. And it's the opposite is true for a put. You are in the money if the price is below that strike price, and out of the money if the price is above that strike price. And like I mentioned, this is a gross oversimplification of how options work, but I just wanted to cover the basics. The thing you also have to realize is that options contracts are not some magical thing you're purchasing from your broker. It's not a stock. It's a contract or a promise. The way it functions is, in the case of a call, if you purchase a call and you purchase that contract, each contract is a promise to purchase 100 shares of a given stock or security at a later date at a given strike price, provided the value or the price of that security is above that strike price. So as an example, if you're purchasing a $30 strike price call contract for Marathon with an expiration of, let's just use next Friday, January 21st. Those are the yearly contracts we're going to be reviewing here soon. If on that day, if on the 21st of January, the price of the stock is above $30, then those contracts are in the money. They will be worth per share whatever dollar amount they are above the strike price, even if that's only 10 cents. Now, the thing is, these contracts can trade hands as many times as you want. You don't have to hold them to the expiration. You can sell them at any time, the same way you would sell a stock. Having said that, the commissions work completely differently. And again, I'm not getting into that in this video. But whoever is still holding on to those contracts after the expiration after the expiration comes, then they will purchase all of those the corresponding number of shares at the strike price. So if that strike price was $30 and at the expiration the contracts or the actual share price is, say, $35, then the holder of those contracts gets to acquire those shares at $30, providing them with a $5 discount to the current share price. So I don't want to spend too much more time explaining the way contracts work, options contracts. It is a complicated subject and takes a good deal of time and practice to understand. If you are interested in actually experimenting with this, I highly recommend you do it using a practice account, not using real money. It is a very expensive skill to learn when using real money. It can be incredibly dangerous and extremely risky. So, fair warning. And in light of what I'm going to show you next, I would recommend probably avoiding it in most cases, at least until you have a really good, firm understanding about the risks and how this works. So, let's get into this. For this example, I am going to use Marathon as our guinea pig. Let's have a look at Marathon's options graphs. The first chart here is outlining the distribution of puts and calls on Marathon. And this is at the expiration date of this coming Friday. You can see there's a whole lot more in terms of quantity calls, that's the brown lines, than there are puts. Far fewer people are bearish on this than there are people who are bullish. Now, having said that, it pushes those incentives for those who are selling these contracts on the market to drive that price down to this maximum pain level. For this coming Friday, the maximum pain level in Marathon is $30. At that price, all options holders, whether they are holders of puts or calls, collectively will experience the greatest dollar value loss. Now, that's not saying that that price is exactly where it's going to close. It's merely indicating the incentives are such that the institutions or the people who have sold these contracts will make the most amount of money overall if the price is as close as possible to that strike price. So the week that I'm interested in highlighting here is the following week. That's the annual expirations, so January 21st. And before I do that, you can see here that the highest price level, the highest price point that these contracts expiring this week go to is $66, and the lowest is $17. When you look at the annual contracts, the lowest here, it goes to $4, but it's actually even lower than that. It goes all the way to $1. Those are the lowest contracts available. For whatever reason, they're not shown here. And the maximum is 100. Again, I'm pretty sure they actually go higher than that even. But as you can see, there's a much wider spread because these contracts are much, much older overall. And the vast majority of them are in excess of $60. Obviously, in early February or later February, March, and April, when we were up at around those prices, myself included, were very overly bullish and got wrecked as a result, playing with these damn things. So again, fair warning, learn from other people's mistakes. These things are very dangerous if you don't know what you're doing. I'm still learning personally, and this is what I'm sharing with you now. So the maximum pain price for next Friday's group or batch of contracts, which is substantial, the number of contracts, that maximum pain falls at about $34. So a little bit north of where we are right now. Because yeah, there is still a substantial amount of puts here as well. It's always going to land somewhere in the middle where everything kind of evens out. And there's even more information that they give you here in terms of the open interest and at what price points. Again, as you can see, massive volume amounts in contracts over $50. But even down around this level right now, 30, there is a significant amount of open interest in both puts and calls. And the most important thing that I found down here at the very bottom is the max pain historical data, which you can see here, these little spikes in here. As far as I can understand from this, actually this is not representing correctly. Sometimes I've found this stuff needs a little bit of you got to be careful that this is not even correct, because you can see we should be much, much lower here. So I've had this happen before. I had to retype this in. Obviously this website's not perfect, but just I retype that in. I go back to the date I'm looking for, and there we go. That looks a lot better. So we're all the way down here now. Marathon had that huge run up to about $80, and we've been crashing ever since. But these big spikes here, as far as I can understand, these are indicating the longer term expirations. When you look at an options chain, and we'll look at that in a second as well, there are certain dates that are available sooner than others. And those are those longer term expiration dates. They always fall on monthly closing dates and yearly closing dates. So this particular one has been available ever since January of last year. So it's a very long-term expiration group. But in the past, you can see all the previous expirations. And after the 21st, you'll see a huge jump in these bars that you see here. But you can see, yeah, we've been falling all along. And even that maximum paying price, week by week, we've seen it dropping along with the stock price, which makes sense. But right now, we've basically converged on those prices so that it's reached, the stock price has reached its maximum paying expiration price. And the reason why institutions or these market makers want the price to expire is if the price is, if those call options were in the money, then the shares that they sold that they secured against those contracts when they sold them. If you hold shares in Marathon or any stock, you can sell covered calls secured against those shares. And it's a way to generate income for the shares that you already own anyways. It's basically free money. Unless the stock actually does explode and your shares are called away at whatever strike price you sold those contracts at. So if they had, for whatever reason, sold those contracts at $30 or $35, for example, if the price is over $35, then their shares will be called away. They will have to give them up at that price, no matter what the price of the stock is trading at the time. This is why they're incentivized to make sure the price stays below whatever strike price those things were sold at. Now, having said that, the vast majority of them, the strike price is well above where we're trading at right now. So there is no guarantee that we'll actually meet that maximum gain price, or that maximum paying price. But the incentive is there. They will try their best to keep it as close to that as they possibly can. I use bar chart a lot for looking at some of this data, and of course anything in a brokerage account with options trading enabled, you can see this as well. But this is the options chain for Marathon at the expiration of January 21st. As you can see, the lowest strike price is $1. So that gives you an idea how long this expiration date, this group of contracts have been open and available for. If you look at normal weekly expiring contracts, the lowest price you're going to get is somewhere around $20 or $15 perhaps. But when you scroll all the way down to the bottom of this chart, it's going to show you how much open interest there is for puts and how much open interest there was for calls. About 150,000 contracts open for call options and about almost 83,000 for puts. And if you compare that to the previous, this coming Friday, it's quite a bit different. For this coming Friday, calls at just over 37,000 and puts a little over 19,000. I saw some comment in the live stream that what they were seeing was open interest in this week a whole lot more than open interest in the following week. Obviously, you can see that's not the case. Not sure what that individual was looking at, but I figured I'd answer it. This is a good place to get that kind of information. And like I said, I'll also leave a link for this website in the description below. So I hope I did a good enough job explaining this. As you can see, it's a complicated and complex topic for those people that are not familiar with these types of financial products. But it is important to understand how these products impact the incentives. You can see that when you have products like this that are available, it does have a massive change on what those incentives are in the market. And if you're just a shareholder, this doesn't impact you in the sense of how you make your decisions when you decide to buy or sell. But if you're a large holder of these shares and engage in selling and generating income by selling those contracts, those covered calls, or even puts, then your incentives are a little bit different, especially if they intend to hold on to those shares. So ironically, it's kind of bullish that the share price has dropped so much, because it indicates to me that these market makers intend to hold on to their shares. They want to ensure that their shares do not get called away. But what that means is if this is happening, and this is the part where it's hard to really prove, because by the time we get the data, it's long after the fact. But if they are engaging in these kinds of practices, they would no doubt be forced to do it through means of short selling, even if it was just temporarily, to keep the price down so that they hold on to those shares. Immediately following this expiration, any of that short selling that was induced would have to be unwound, and those positions would have to get covered, which could lead to a significant short squeeze. But the money that they're able to make through these kinds of activities far outweighs that. And remember, they still own the underlying asset at the end of the day. So keep this in mind, and keep an eye on these longer term expiration dates, because that I have found when we approach those dates, we inevitably see significant pullbacks in the price. And again, this is not exclusive to mining stocks. This is to do with all stocks. And I've seen similar behavioral patterns in the broader market. I mean, let's face it, that's what we just witnessed. The entire stock market has these same annual contracts expiring at the same time. So this is not exclusive to mining stocks at all. But it does appear to affect some more than others, since not all not all companies or stocks out there have options chains. Certainly not last January, especially the Canadian companies. If you search them on that website, you actually won't find anything. Even though those options are available now, they're still not available on that particular website. It could be just a data thing, or but also the reality is a year ago, when these contracts were first made available for companies like Marathon and Riot, companies like Hut 8 and Bitfarms and various others, Hive, they weren't listed on the NASDAQ at the time. They didn't have options chains at all. That's relatively new to them. So that's something to keep in mind. This is why I'm focusing on the big ones, Marathon and Riot. For anyone curious, Riot, for example, I'll pull that chart up before we finish off here. Riot's max paying price for this coming Friday is $21. And for next week, it is found to be $24. So yeah, not a whole, I mean, it's up, it's certainly up. And again, anything can happen despite these prices, these targets being there. It's an incentive. We could easily find ourselves $1, $2, $3, even $4 above it, or heck, below it. I doubt, I'm certainly not leaning in that direction right now, but anything can still happen, especially when you throw Bitcoin into the mix. I do not believe that this is such a vastly coordinated effort. It merely outlines what the incentives are, something that we should keep in mind on a going forward basis. I'm going to be keeping an eye on this going forward. I will share what I find with all of you when I see it. But in the meantime, I hope you guys are all staying safe. That was a brutal last few months, and I hope this is it. This does seem to indicate our first glimmer that there could be a reversal, that we may have bottomed. It's not all going to be smooth sailing. There's plenty of uncertainty out there. I don't have it all figured out, but I'm doing my best here. I'm going to keep sharing what my thoughts are as I have them. And in the long term, I have no doubt that we will see greener pastures, and we will once again experience that same market cycle of euphoria and over exuberance and excitement. And then we'll have to remind ourselves what this feels like. Getting beat around like this certainly hasn't been fun, but it's not going to end anytime soon. That's the nature of these markets. Let's just try to get a little bit smarter and understand what those incentives are for ourselves. Then we can make better decisions. That's all for this one. Now let's get back to empire building.